All right, everyone, welcome back to another weekly roundup of On the Margin. Today, I'm joined, as always, by my energetic co-host, Mr. Mark Yusko. And I said energetic because, Mark, it's been a couple of weeks.
I was going to say,
this is the
it's
longest
not
break
as
we've
always.
taken.
I feel like, we haven't been together for, it's coming up on almost a month. I mean, it's actually only 21 days, but it feels longer. And a month ago, we were together. That was kind of the last time we did a show. Yeah. And, that was the day, Bitcoin was down 20% that day. The markets were crashing. Everybody was like, Powell's going to, raise rates. And I said, I should have worn the red pants today, but I wore the Bitcoin orange pants. So I am taking full credit, 100% for the 50%. Bitcoin is up 50% since that day in 4 short weeks. So I am wearing the Bitcoin orange pants today. I have the Bitcoin bull sock game going. So the cape and the big green candles. And I'm pretty psyched about, I'm officially declaring 3 weeks from Tuesday, this coming Tuesday, is the official start of crypto summer. That also happens to be my birthday, but that's going to be the official start of crypto summer.
That's very precise. And I tend to agree with you. So yeah, I mean, look, it's been a very good couple of weeks for crypto. What do you attribute the, sometimes there's not necessarily a reason for why price does what it does, but
there's no more sellers, right? Sellers are gone. All the big leveraged bad guys are gone. And it turns out that I just did a presentation on this yesterday. Hash rate, new all-time high. Number of wallets, new all-time high. Number of wallets with greater than 0.1 Bitcoin, new all-time high. Transaction size and volume, not all-time high, but coming back to being close. And all of those fundamentals are and my point of my presentation yesterday was, crypto summer, surfing on a wave of global liquidity. China printed $1 trillion since October, trillion with a T. Japan, another couple hundred billion. The Fed put $300 billion back on their balance sheet. So, we've got $1.5 trillion of liquidity sloshing around, and turns out people buy things that they like. And there's a whole bunch of people that like crypto, and Bitcoin and ETH are the biggest beneficiaries, but it's going down the ladder too.
Yeah. Now, when it comes to ETH, we've actually got so we're recording this on April 14th, and we've actually got the long-awaited chappella upgrade. For the uninitiated, that is when you as an ETH staker are finally allowed to withdraw your Ethereum. And this has been the subject of a whole bunch of speculation within the crypto community. And basically, people are of sort of two minds. And I think the consensus forming has been, hey, some people have had their ETH locked up in this contract for a very, very long time. And people should be careful because, people are going to need liquidity. We're just a couple of days away from tax day. People have been accruing rewards. They're going to need to pay their taxes. And there's going to be a decent amount of sell pressure. It's looking like that might not actually be validated. And the flip side of that, the slightly more bullish take, is that, look, staking is a core part of Ethereum, the protocol. It's a sign of health. And now that, the chappella upgrade is going to be live, people will understand and know that they can withdraw their Ethereum. It's not theoretical. There will actually be proof that staking contract will be de-risked, and actually more people will end up staking, and that'll be good for Ethereum's price. Yeah. So, Mark, would love to know your kind of thoughts on this whole Shanghai chappella upgrade, and your thoughts kind of on the short-term price impact for Ethereum, and then like more longer term.
I'm with you. I just look at the data, right? The data is there's more buyers than sellers of ETH. ETH, I think I have this right, over the past couple of weeks has even outperformed BTC. I mean, it was up 5% yesterday. It crashed through 2000 and hit 2100 very quickly. So I kind of come down on the latter part of your analysis to say, yes, there's a legitimate fear that people would unlock or de-risk some portion of what they've been staking. But I kind of come to it as there's no evidence of that, right? There's just no evidence in the markets of big liquidations of really anything. And there's some lower level coins that have just been going batshit crazy. So I think it's interesting.
Mark, we call those small cap gems.
Small cap gems. I like it. Small cap gems.
Yeah, but this is the ETH versus Bitcoin price. For those of you who are following along via video, the last 5 days looking at ETH versus Bitcoin, market jump in ETH USD here over the last day or so. So I guess we'll have to see how that plays out. And I guess the caveat is sometimes the market gets this wrong initially. So I would still always be careful. And none of this is financial advice, but definitely things are looking up for crypto. And me personally, I'm more optimistic than I've been in a little while. I feel like I've been optimistic about this entire time, but
look, it's tough. It's tough to maintain optimism and energy in the face of constant beatings, right? The whole line, the beatings will continue until morale improves. Well, morale ain't going to improve. I mean, you beat people down and they will sink lower and lower. And it was a summer of beatings last summer, or fall. It was a fall of beatings. And, bad people doing bad things, and then government actors doing bad things. And suddenly there's this reprieve. Now, look, I do think it's the calm before the storm. I don't think that then they fight you phase is over. I think it's going to come back with us. Ms. Warren is assembling her crypto army. Could there be literally a dumber campaign slogan than that? I mean,
well, it's a good thing to rally around if you are a crypto supporter.
The average person that votes for Ms. Warren doesn't even know what crypto is. I don't mean that derogatorily. I'm just saying they have no idea, right?
No, I meant for crypto people, it's a good thing to rally around. It's like such an anti.
Yes.
But, it's like, I mean, come on.
It's so inane. I don't know. Look, this is what's happening right now everywhere.
I mean, it's still such early days for crypto. I know you were in Costa Rica, and I was just on vacation. I was in Texas, and I was reading. I've referenced this on the podcast before, but I was reading the biography of, the Ron Chernow biography of John Rockefeller. So it's that book Titan, which I'd very long, but I would highly recommend it. So super good. He's got a whole bunch of great, biographies, and he, just reading about the early days of oil. So one of the funny things about Standard Oil that I felt very silly going into it, I thought he made all this money selling, crude oil for cars. No, he actually made all that money on the kerosene market. The vast majority of Standard Oil came before the automobile.
It's unbelievable,
which I just didn't know. Yeah,
no, it's unbelievable. And the thing that people don't know, and I tell people this all the time. I mean, the man was a mad genius. Now he was also a badass. I mean, he was kind of a bad guy. I mean, he made more people disappear than the Clintons. I mean, he disappeared a lot of people. Like, you strike against one of his factories, you disappeared. I mean, it was ugly.
I didn't know, but the parallels to it is, I couldn't help but I was like looking at this through the lens of, I actually took a photo of one of the pages, but I'm not going to read it because it's very long. But basically, the whole idea is that, oil back then was there'd be these gushers, right? It was very speculative, very boom bust type industry where oil would be discovered. They called it, there'd be like a big gusher. As soon as word got out of a big gusher, the price would go way down for a very long period of time. There would be these boom towns that would rise up around where a big gusher was found, and then they would go away. Even down to like, people were very concerned about fire back then. People were very worried about investing in refineries because, all this stuff was super flammable, and all the structures that the refining was done in was in wood. Very similar to DeFi hacks, right? Like you could, it was considered a very risky investment.
It's a great analogy. And again, what people don't know, and I think it's interesting that people don't know, is the reason we operate our cars on gasoline instead of either electricity, which at the time in 1903, the American Electric Vehicle Corp was the largest car company in America. They made the first horseless carriages. They were electric.
Really?
They got
I did not
47
know that.
miles to a charge, and these big giant lead acid batteries. But that's what it was. It was the biggest car company in the world. And this guy Henry Ford had designed this new car called the Model T, and he was going to use grain alcohol to run the combustion engine. And his friend John D. Rockefeller said, "Well, Hank, I got this stuff that I flush down the river, because when you create lamp oil, kerosene from oil, you have this effluent, this waste called gasoline." And he was literally flushing it down the river, and the rivers would catch on fire.
I know, yeah.
Just the buildings, like the Cuyahoga River would catch on fire. And he's like, "Hank, here's what we're going to do. You give me some of your company, I'll give you some of my company, and we'll use this gasoline in the engine, and we'll put American Electric Vehicle out of business." And that's why we run on internal combustion engines. And now we're going back, towards EV. But it's funny. I mean, individuals are very, very. I mean, look, and he was before, and it's hard to compare. It's like comparing Michael and LeBron. John D. Rockefeller, Bill Gates. Who was the more ruthless businessman? I don't know.
It'd be tough. It was also, you have to take into account the time period that he was operating in, which there were no rules. I mean, even here, there were no rules. Yeah, I mean, he basically did write the playbook for corporate America. And one of the things that I didn't really understand, the whole idea of being a joint stock issue, like a joint stock kind of corporation, that was an old structure, right? That like the East India Company, they kind of invented, but I didn't realize it had basically gone unused. And one of the big challenges that Standard Oil had was, at the time that he was operating, you couldn't operate in multiple states. Correct. So there was a bit of a sort of corporate innovation, that happened, where basically he had a trust, so you couldn't operate in multiple different states.
That's why he had Standard Oil of Indiana, Standard Oil of California. I mean, he created individual companies to get around this. And look, all of antitrust law today, pretty much all. I mean, it might not be absolutely all, but pretty much all is because of Standard Oil. Because the government said, whoa, this guy, way too powerful. And he was the most powerful person until the guys from Sullivan and Cromwell kind of took over DC, and they've been in charge for a while. But
so here's another mind-blowing fact. When they went after Standard Oil to break it up, you know how the entire Justice Department in Washington, D.C. was 18 lawyers. Does that blow your mind?
Yeah.
I was like, I was reading that, and I couldn't believe that. I mean, it was just a totally different time. And if he also did, create order out of an industry that was complete chaos, in not necessarily a particularly good way. But let's get into some more contemporary stuff here. And I've got some charts for you, because this was CPI week. We also got PPI this week as well.
Well, it's amazing, Michael, as you're pulling up that chart, it's amazing how no one's talking about inflation anymore. I mean, it's gone.
I know.
It's gone. I mean, literally gone. I mean, if you do a Google search for, what is that Google Analytics thing for searches on inflation, it's gone back to nothing.
Yeah. Well, I think, the reason for that is the consensus is definitely that inflation has peaked. And there's a lot of debate about how sticky certain components of inflation are going to be and how long it's going to be with us. But generally, people aren't very worried that it's going up anymore. So what we're looking at here is a chart of core CPI year over year versus US CPI year over year. So, this was, I had kind of unplugged for the last week. So I kind of tuned in a little bit for when the CPI reading was published on Wednesday at 8:30. And, we had core coming in over headline CPI. We had 5.6 versus 5.0, which was, pretty interesting to me. We've got here U.S. core CPI year over year percent. So this is the contribution by specific categories here.
Look at
So
those orange lines. We talked about this. We said it was going to happen.
Yep.
Oil prices down year over year.
Yeah. And actually, I don't have this chart here, but if you look at the SPR, the Strategic Petroleum Reserve, it's half of what it was at one point. There was definitely an enormous amount of selling. So I don't know if the administration is concerned about oil prices going back up, but you definitely wouldn't want to, you definitely wouldn't want a situation where they have to refill the SPR and oil prices are going back up. But yeah, Mark, what do you think when
exactly what's going to happen? That's exactly. I mean, look, that's why Saudi cut production.
Yeah.
Right? Saudi has said, you know what? We got new friends, and these new friends, they treat us better. And I think we're going to look back 10 years from now and what this current administration did to mess up this, 50-year relationship with OPEC and Saudi. I mean, people are going to, it's going to be shocking. It's going to be shocking.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. Yeah. Well, let's take a look at, so basically the big component that's still in, core CPI is shelter. And we knew that was going to be the case, right? Because shelter lags quite a bit. But, that makes up, almost, like 3.5% basically of headline of core year over year. So what are your other kind of takeaways just looking at this chart? Any surprises to you?
I mean, no surprises at all. I mean, just as we've been talking about, that the two things that really caused the spike in CPI, which were oil prices and used car prices, 70+%, have ameliorated and gone away. And I think they'll continue. Although I do think oil, because of this new, pact between Saudi, Russia, and China, does have some potential to get a little dicey over the next few months. So, but I think supply chain is going to be mostly fixed within the next few months. China's fully reopened. I mean, we did a webinar with our China team the other day, and a month ago we sent our analyst out with this iPhone, and she took a picture, and it was like a neutron bomb went off. I mean, there was no one on the streets, there was no cars, and she went out a couple weeks ago, same spot, and it was like it never happened. I mean, smog. I mean, cars. No one. I mean, everyone was out. Big shopping bags. I mean, so that's. I think that's going to get fixed, and I think the shelter thing is. Look, owner's equivalent rent, I've always thought was a dumb concept, right? The rent you charge yourself to rent your house from yourself. Okay, but it just doesn't make any sense to me. And I understand why they took housing prices out and put that in, because it's more stable and they can control it. And I get it, because the goal of the government actually is to have the lowest CPI number possible, full stop. And so the fact that it went up and that they lost control is telling, because, and the reason they want it low is all of the entitlement programs are linked to CPI. And that's why CPI has been manipulated. If you go to shadowstats.com, John, I can't remember his last name. And if you calculated inflation the way we did in the 80s, we're at 10%. If you did it the way we did in the 90s, we're at like 12 or 13%. And I don't really think that's true. but I'm open to the idea that, look, housing prices probably should be a meaningful component of this quote unquote idea of inflation, because it does imply the ability or inability of the average family to, you know, own a home, buy things, you know, that that's real. And, you know, the average young family today has basically been priced out of most markets, especially with rates now where they are. I mean, there's just no way.
It's top of mind for people, all this stuff. I mean, it was even in when I was, in Texas this week on, just sitting around a campfire, people were talking about how crazy rent was. And one couple was talking about how they moved out of Seattle because it was too expensive there, moved to Texas. Now they're considering moving to an even more rural part of Texas. Like,
Right.
it's top of mind for people for sure. So there's kind of these government statistics, which financial markets care a lot about, but then there's just the popular discourse, and
Look,
people's.
real life is hard. I mean,
Mhm.
I went to lunch with a guy. It's one of the things I love, right? I'll run into somebody on Twitter and they'll say, "Hey, you want to get together?" And there's probably somebody who would say that, you shouldn't meet everyone you meet on Twitter in real life. But went and had lunch with this guy, great guy, actually runs a very cool business that all of us sadly are going to need, which is home health for aging parents. And, we chat about a bunch of stuff, but, he picked up the lunch tab and two guys in North Carolina, Chapel Hill, North Carolina, not New York, not Seattle, it was almost $50. And we didn't even have anything. I mean, we had a normal lunch at a pizza place. It's crazy. And so
Yeah.
that level of expenditure, well, I mean, little things like I took the little guy down to Costa Rica for spring break. So we wanted to do the rainforest thing. And, the place we stayed was a nice place. It wasn't like the, Taj Mahal, but every little thing we did, like we did rock climbing and, oh, that's extra. And we did this little rafting trip. Oh, that's extra. And, he wanted a Coco Loco drink, the virgin one. And, that was like $7. I'm like, okay, we're captive. We can't go anyplace else. We're in the middle of the rainforest. There's no other stores around. I get it. You can charge us whatever. But things are expensive.
They are. And, I think your point about entitlements is a super important one. I don't know how much you've been following, and I haven't been, diving super deep into it, but I've been kind of following the headlines of what's going on in France, which is pretty
Yeah.
interesting. Like, they tried to raise the retirement age by 2 years, and people are literally rioting in the
Yes.
streets. I mean,
Yes.
fire, there's,
Which is
I
insane.
mean,
Everyone
it's
needs
great.
to do this. And
Yeah.
it's not wrong. It's not bad. I mean, the reality is when these entitlement programs were set up, the average life expectancy was lower, right? People died. I mean, when Social Security was set up, the average life expectancy was 58. They set the age at 65. That was a good plan. Now the life expectancy is 78, and we should definitely move it up. But just the problem with entitlements is an entitlement is a promise you make to yourself that you don't fund and you ask your kids to pay for.
I
Who
agree.
wouldn't vote for that? Who wouldn't
Yeah.
vote for that?
Yeah. I think that is the problem. I mean, I think whether it was with good intentions or not, a large group of people were given an unrealistic expectation about
Yeah.
like the entitlements that they were owed based on the work that they did, or I don't know what it is, but there's a lot of stuff that's going to need to get squared over the
Well,
coming
but here's
years
the
because
thing, right? Telling people that, okay, you can't start collecting for another couple of years. Okay, let's think about that. We're not saying you're going to collect less, right? Because we now know you're going to live longer on average. Okay, so you're actually going to get more from the system than we thought 20 years ago. And we're not asking you to put more in, right? mean, we're taking the same amount. But people feel like you're taking something from them. But you've been given this. And it says, no. I put the money in my money. Like I shouldn't tell this on my mom, but my mom believes there's a little pot in DC called Judy's money. I'm like, Mom, there's no pot. She says, what? No, I put all this money in. I'm like, I know, but it went to your parents. And now I'm paying for you and Dad. And then my kids will have to pay for me. That's the way we have run it. I mean, every place in the world other than Singapore runs it like a pay-as-you-go system, not like an insurance company. Look, you could solve the whole thing. You could solve all of entitlement problems by turning them into insurance companies and running them like insurance companies and investing the money in things that produce wealth and innovation. And that would solve all the problem. But nobody wants to do that. I always joke, it's the one thing. I was not a big W fan at the time. I like him now, but it was the one thing he said that I thought was smart. Now his timing was bad, right? He wanted to do it right in 2000, but he'd said, look, we need to invest the money in Social Security. Yes, you do. You can't just leave it on a ledger, say not a ledger like thing, but you can't just leave it in on a spreadsheet saying, well, when Jimmy and Johnny pay in the future, we'll pay out John and Mary. Invest the money, make it grow, and then you'll have the money to pay Jimmy and Johnny and everybody else.
Yeah. Mark, what do you like, just zooming out for a second, like where do you think we're sort of at in the business cycle here? Because, there are a couple of factors that I just have a little bit of trouble squaring. So we just talked about there's still at least headline, there's a 5 handle on inflation now, which is, going down, but it's definitely not near the level that the Fed wants, which is 2%. There's still probably stress in the banking system, right? So it seems like the Fed has kind of solved the problem for now with this BTFP facility. There's actually a great chart here that my colleague Jack Farley put together. I'm going to show this. But that's like, it seems like the problem has been at least temporarily solved for now. But, there's still like kind of the worry that, we can't push too far. This is kind of this is a use of the discount window, which has been around for, 100 years. And then there's the use of the BTFP facility, which has been going up and up. So it's just a cool chart to look at right next to each other. And then there's also kind of these forward-looking economic indicators, which I was kind of just showing this chart, but PPI is turning around, so we've got, kind of significantly negative PPI here. So, putting all these factors together, like where do you just think we are in the business cycle right now?
I think the economy is slowish. I think first quarter number is going to disappoint. Fourth quarter number got revised down. Still not horrible. And look, last year, even though they're not going to call it, was a recession. It was a mild recession. 1% year over year, 0.9 year over year GDP. That's recession. That's a 2001-esque recession. And I think in the absence of the global wave of liquidity, right? Had China not printed $1 trillion, had, Kuroda-san as his, going away president, not printed another 200 billion, had the Fed not stepped in with Silicon Valley at all with this BTFP, I would be more negative on growth. I would say, negative GDP growth in Q1. I would say negative GDP growth in Q2. I don't see that, right? I see a 1 handle in Q1. And look, I think the biggest indicator is the 10-year. The 10-year yield has collapsed, right? It's down from 4 something to 3.4, something like that. And that's telling you that growth is decelerating, not accelerating. Yet, if you look at Chinese liquidity provision forwarded 6 months and PMIs, it would tell us that PMIs have troughed and that economic activity is going to rise, albeit slowly. But so I think we're going to avert the hard crash landing. This idea of no landing, I think that's just a silly idea. There'll be a landing. And I think you see it in activity, right? I went to a restaurant with the family the other night, and it was bustling. It wasn't slammed, but it was bustling. And again, this is a nice restaurant in, we don't have very many super nice restaurants in Chapel Hill, but we have a couple of nice restaurants. And it was full. And that's a good indicator. The airport over spring break, slammed. A lot of people traveling for spring break. So, yet traffic, I don't know about where you are, but traffic is a little bit lighter than it was. That's usually an indicator to me of economic growth. So to answer your question, where are we in the business cycle? I think we're past the trough. I think we troughed, middle of last year, third quarter or something like that. We kind of fudged the numbers with the SPR, right? We would have had much worse GDP prints last year if we hadn't drained the SPR and double counted the oil. I think that's a scam, but people believe it. Okay. If they start reversing that and start putting oil back in, that could juice that could hurt the numbers the other way. But I don't know. We'll see.
Yeah. It's just, I think a lot of people were waiting for kind of this big biblical, sort of comeuppance, right? It was the largest withdrawal of liquidity, pick your time frame. And we didn't really get that. We got it in crypto for sure.
Yeah.
Definitely a rough 2022 for if you were operating in crypto. But, if you look at a chart of the S&P, it just wasn't really that bad.
Well, but remember the 60-40 worst year ever, 140 years of data.
Bonds got smoked.
Your average
got smoked too.
401k had its worst year ever. Now it wasn't a, 401k turns into 201k like the global financial crisis or 2000, but it was ugly. It was ugly. And if you owned tech stocks, ugly, right?
Ugly.
We're talking down 35, 40%. And you've rallied back 15, but you're still down a lot. And I think that's the part where, I got in this interesting debate. There's I won't name names, but there's this guy out there, and I like him. He's a reasonable guy, but he's on this toot about how he didn't understand why everybody thinks things are bad. Everything is awesome. And I'm like, what are you talking about? He says, oh, look, stocks are back towards all-time highs. I'm like, what? Only because we're denominating in a currency that's getting devalued. I said, if you denominate the S&P in gold, it's dead flat. And I showed this chart yesterday. If you look at the last 20 years, okay, all of the increase in equity is the Fed balance sheet. 100% of it. 100% of it. And so when equities rolled over last year because they tried the QT thing, what did they do globally? Turned it back on. The QE is back on, and we are back to QE infinity. And because you have to, right? You can't have this entitlement program. And this is everywhere. This is Western Europe, Japan, US, all have the same problem. Aging population that's been promised all this stuff. You put their money into these passive 401ks, 403bs, and you cannot have a situation where the value goes down and they have to cover it. They don't have the money. There's no savings. Savings rate is plummeted. It's plumbing new all-time lows. And that mythic savings that, by handing out the money in the lockdowns, that wasn't savings. you counted it as savings, but it wasn't savings.
Hello, everyone. Thank you all for listening to On the Margin. Just wanted to give you guys a heads up about a conference that we have coming up in the new year called Permissionless. I'm sure most of you have been there last year. It is the cultural event of the year. We had over 5,500 people down in Palm Beach. This year, we are moving to Austin, Texas. You know what they say about Texas? Everything's bigger in Texas. So last year we had a really great lineup of speakers. We had the 2 co-founders of Robinhood, Vlad Tenev and Baiju Bhatt. We had Chris Dixon. We had some of the folks that have been on the show a whole bunch of times, Jim Bianco, Dan Tapiero. Just a phenomenal lineup of speakers, and you can expect the same this year. If you use Margin 10, you'll get 10% off on a ticket. Again, that's Margin 10 because I love you guys so much. Click the link at the bottom of the show notes. Hope to see you there in person. So, yeah, I'd love to get your thoughts on the balance sheet here because there's I mean, it's almost like this MacGuffin or something like that. People debate, endlessly about what the Fed balance sheet really means. Ultimately, I have kind of a theory, like a left bell curve sort of theory about what this really is. But I think the consistent thing about the Fed's balance sheet is that they haven't really been able to get it down, right? Various Fed chairs have pledged and said, hey, this is not going to be permanent when we do something like QE. And they always are, somewhat successful in, tapering and then actually, selling off some of the assets in the Fed's balance sheet. But then something happens, right? And for at the end of 2018 or 2019, we got the pivot for the Powell pivot, which he's sort of famous for. And, similarly, people point to the BTFP and say, hey, well, that's not QE. And I agree, it's definitely not. It's a lifeline to the banks. But on the other hand, they couldn't get too far into selling assets off the Fed's balance sheet here. So, Mark, what do you kind of think when you see this chart?
QT, okay, fine. It's not, it's not QE. It's not quantitative easing, but it's a provision of capital to a system that doesn't balance. That's at the end of the day what the Federal Reserve is, right? It's not a bank, okay? It's not federal. It doesn't have any reserves. There are no deposits, right? It's not any of the things that people think. It's not a bank. Mm-hmm. And what it is a private corporation that has a mission, essentially, to liquefy balance sheets of banks, right? That's its job. To be the lender of last resort and essentially create money out of thin air by lending money to these institutions, and then they can deposit it back with the Fed and earn interest, or they can buy government bonds. And they can also buy equities, even though they're not supposed to. That happens. You look at the bank balance sheets; they actually have a whole bunch of equities, but they're not supposed to do that. But so it's Ponzi-nomics, Michael. It's literally Ponzi-nomics. It is what that chart that you just showed says to me is, and it's the same chart in the Bank of Japan, but worse on steroids, right? It's an even steeper slope, 60-degree line. Same at DCB, same at the Bank of Japan. When you start down the road of a debt-fueled expansion, okay, where if I have $1 of equity and you have $1 of equity, and we combine those $2 and we start a business and we go out and we generate sales and we make mama dollar and papa dollar, make more dollars, okay, great. That's good. We worked hard, made some money. But if we say, all right, mama dollar and papa dollar, hey, bank, give us $10. So we have $12 to go, buy more stuff. And in the early days of debt, it's amazing, right? You get more than the dollar of debt impact on incremental GDP because, there's actually stuff that people want and people need. And then as you go on, when the debt gets higher and higher and higher, the incremental return to that incremental dollar of debt falls. You get to a point, actually, where it actually has a negative return, right? Because how many TikToks can you watch? How many,
apparently infinite.
How many tchotchkes can you buy for your shelves? I don't got room on my shelves for any more tchotchkes. I mean, how many books can you stack up and never read, right? At some point, you're just done. And so then it's, oh, well, experiences. Okay, now it's experiences. Okay, fine. But again, there's only so many hours in the day. You got to sleep, stuff like that. So at some point, we reach, and I think we have reached in many cases, the tipping point where now we're generating debt and spending just because we have to. It's like a shark, right? If a shark doesn't keep moving, it dies. And look at the government and deficits, massive deficits. Well, how do you fund a deficit? You have to issue debt. Well, who buys the debt? Well, if the rest of the world says, I don't want your debt, then the central bank's got to buy it. And if you look at the central banks, that's what they do. They just keep buying those government bonds. And the funny thing is, Kyle Bass was screaming about this for years about Japan, that it had to end badly. Well, it hasn't, right? Japan today at 226% of debt to GDP on the Bank of Japan balance sheet is mind-numbingly interesting.
It's still functional.
It shouldn't work.
I know.
But it did, and it does. And you go to Tokyo, it's a pretty cool place.
It is. And, I think with the benefit of hindsight, the challenge here is I don't think many people, Mark, sit there and think, hey, we can run a deficit forever into perpetuity. The challenge is, right, the amount of timing. So I think one of the problems with this, and there's like a little bit of a boy who cried wolf syndrome. So I talked to Jim last week, and I read this book. You probably read it as well, Market Wizards, and that was written by a guy named Jack Schwager back in 1989, and he interviewed all these great traders and investors. Paul Tudor Jones is in there, and back then in the late 80s, they were talking about, the U.S. has started to run a deficit. We are going to go into hyperinflation. Even back then. And in hindsight, that sounds very silly. There's obviously a lot of room to run. We are, the dominant superpower in the world. Of course, we've got a lot of good credit, but we don't have infinite credit. So the question is, so for years now, for like 30 years, we've had people saying this system's going to come to an end. And it's kind of given rise to this other, well, hey, you guys have been saying this for a long time and it hasn't happened. So you're probably going to continue to be wrong. And those people are probably going to continue to be right for a period of time. But ultimately, household, there's this kind of line about how household finance isn't like government finance. It's not really, but it is in the end. In the end, it actually is exactly the same. And the U.S. has all these. Your word is exactly right. These entitlements, like we have written checks that we can cash, but we have to print money to cash those checks, and that is going to have consequences.
Yeah,
that's going to have consequences. That's
and
the way that I feel about it.
The reality is, we will get through it. This is the weird part, right?
Yeah,
we will get through it. And the funny part to me is always 10 years out, 20 years out, looking back, we'll have this quaint notion that, remember the good old days when, Coca-Cola was only $4 instead of $20. And for whatever reason, we convince ourselves that the current prices are always reasonable. Mm-hmm. Because what happens is everything devalues together. So incomes go up, prices go up, home prices go up, everything's more expensive. I mean, if you look at that, we've all seen it, right? In 1950, a house was $5,000 or $25,000, and a car was $3,000, and the average income was, $2,000 or whatever it was. And then 20 years later, those numbers all double, and then 30 years later, those numbers all treble. And it's funny. It's like I'll have to pick on Tesla, but a $75,000 Tesla, right? It's a rich person car. That is not a car for the masses. That's a rich person car. But at some point, a $75,000 car is going to be an economy car, right? I mean, the idea that you could ever spend, when I was growing up, there weren't cars. I mean, Lamborghinis and Ferraris, but there were no car. Even Mercedes didn't cost $75,000.
Yeah.
I mean, and Mercedes was it, right? In terms of luxury, there was no Lexus, there was no, nothing. And, now it just becomes commonplace. Or I don't know if you tried to go to you tried to go to a concert. I mean, I don't know what that ticket costs.
I don't even want to tell you.
No, I
it
know.
was not cheap.
And you think that's normal, right?
Mhm.
And I remember buying a ticket to a concert for the same people you saw 40 years ago, or, and it was like $10.
Mhm.
I mean, literally
Not
$10.
many $10 concerts today. Yeah. Now, Mark, I know we've got a couple more minutes here, but I've got one thing that I have been struggling to square a little bit mentally is, when I look at, and I've got a bias, I operate in crypto. So I'm I have a naturally maybe tilted long bias on that space. I'm very constructive on it. But, when I kind of look out into the world of crypto, I kind of see, everything kind of bottomed, I think, in November and December last year around FTX. So FTX imploded. We didn't put in a new low. All the sellers basically did what they were going to do. And now I totally agree with kind of yours, no sellers left basically in this market. And I think it's going to do very well. On the other hand, I kind of look out into the broader economy and it's like, maybe there is still another, shoe to drop. That now the problem historically is that there's been a strong correlation in between the price of Bitcoin, Ethereum, and the rest of crypto more broadly, and kind of like high value tech stocks, right? Or high growth tech stocks. So I'm having trouble squaring these things in my head where I feel very constructive and optimistic on crypto as a space, but I don't feel particularly constructive on, sort of the economy and the stock market in general. So do you also agree with that? Or am I missing something there? Or how would you kind of square that circle?
I think part of the challenge for you, for me, for people like Jack, for people like Jim, that actually look at data, is we kind of get polluted, and I don't mean that in a negative sense, but and polluted is maybe the wrong word, but we get.
I think I know what you mean.
We get a dose of reality, right? And when you look at the actual data and you look at, economic slowing and deglobalization and, closing of trade routes, and you look at what just happened with China and Saudi and Russia and what that means for the petrodollar system, it's really pretty easy to get kind of, I won't say bearish, but definitely concerned that, like I said, there's another shoe to drop. But here's the thing. And this was the point of the global liquidity wave. The world has decided, and look, and when I say the world, I do mean that. I think, every year around WEF, the leaders get together and the finance people, the central bankers, which this kind of does piss me off, right? Because I remember a time when the central banks were not important. They were not gods. They were not the most important people in the world. Now they are, because they are keeping the Ponzi afloat. And what they decided was to turn the spigots back on. And you can call it whatever you want. You can call it QE. You can call it not QT. You can call it, lender of last resort. You can call it BTFD, whatever you want to call it. Doesn't matter. Hundreds of billions, trillions of dollars are flowing into the global economy. And that is going to push risk assets. And look at the risk assets. Look, the valuations of things like Apple, stupid, right? The company's not growing. It is not growing a top line at all, like zero. Same thing with Amazon, same thing with Netflix. They're not growing. But yet, we've got them right back. All of this move this year is just multiple expansion. We've pushed them right back to 25, 30, 40, 50 plus times. And that's illogical. But it's because there's so much liquidity sloshing around. And And that's why I think, look, crypto is where it is. Look, crypto's up 100%. Bitcoin up
Yeah,
100%
I
off the
know.
bottom.
And
100.
people, I know, and people aren't, we're basically right where the reason I have become like pretty excited about it, I feel like I've actually been, relatively constructive this whole time, at least since November, December, but we're up 100% and there's not a whiff of euphoria. Not a whiff.
None. No one's
I know.
buying.
No one is buying.
GBTC
I know.
volumes are dead.
Is
BITO volumes are dead. We run this little thing called CRIP. No, I mean, none, zero. No
so
one's
that
buying
that has to
digital
excite
assets.
you, right? I mean, it says it's double, and there's like no one that's particularly
Nope.
excited about it.
Nope. It's
Very
all,
interesting.
it's all people who are already in. There's no new volume from retail. Now, who is buying? Michael Saylor. Michael Saylor just bought another 1,000 BTC. He now owns one out of every 150 Bitcoin that will ever exist in history. He's basically created, I love this, he's actually created the Bitcoin ETF that the SEC won't approve.
He has.
And it's levered, which is even better because there's no way they would approve that. So, his stock's up 150% off the bottom, not 100 because he's got the leverage. And so he's buying. Well, who else is buying? Well, CZ had to buy a bunch to, give people the money that they withdrew because he had a big run on the bank when he got sued by the US government. Again, just more FUD. So big short squeezes. There are a lot of people who are short. Those short squeezes are over. If we get even a whiff of demand, like normie demand, it's going to be unbelievable. And look, I think that's where we're headed. Like we're going to see a parabolic move coming up to the halving or maybe following the halving. I'm not sure exactly the timing, but sometime between, May 9th of this year and May 9th of next year, we will see a FOMO rally just like every other cycle. And I don't know what the number is going to be. I'm very solidly in the camp that every halving we get a zero, 10, 100,000, 10,000, this one's 100,000. And so that becomes the anchor of value. The network increases by tenfold over a 4-year cycle. But you can go way above that. I mean, way. So who knows? At 10, we got all the way to 70. So that was way, way too high. And then, we never got back to 10. That's interesting.
That is interesting. Yeah. What do you think about, in general, it's just also like law of large numbers, sort of like we're not going to keep, the rate of increase for crypto over these cycles can't keep doing what it's doing. Otherwise, if you do the math in like 3 cycles, it's going to be.
No. And it hasn't, right? First cycle, I just did this, right? We get a down year. Then we get 3 up years, down year, 3 up years, down year, 3 up years. So 2 cycles ago, the 3 up years were like 1,000%, 600%, and 400%. Then the down 84%. Then the 3 up years were like, 300%, 400%, and 200%. Then a down year. And then, it was like 120%, 60%. And so that, to your point, the law of large numbers is kicking in. Now, we can still go up tenfold total, but we're not going to go up 100-fold or 50-fold or even 20-fold. So I think what's really interesting is the way a Metcalfe's law curve works, right? Is that slope does keep getting lower and lower. You don't have the 60-degree slope, then the 45, then the 30, then the 20. And even when it's, 25, 30, 40, 50 years from now, when the slope is only 5 or 10%, it's still going up. It's still increasing in value.
Yeah.
And it's on a very large number. So the total asset value grows, but the rate of increase slows.
Yeah. I think people got it right. I mean, people have been saying this for as long as I've been in crypto, which is, it's very risky and the majority of these assets, people always say like 95% of these assets aren't going to be worth anything in 10 years.
Sure.
And I broadly think that's right. And I probably think what you need to get used to if you're investing in crypto is the big assets that people have a lot of conviction around, Bitcoin and Ethereum. Those are not going to produce they're going to produce great returns, I think, still, but they're not going to be the mind numbing, crazy
Nope.
100X's. I mean, those days
Nope.
are over, I think, for both those assets. But on a risk adjusted basis, you've de-risked an enormous amount for both of them. So I think that's still pretty good. There are a
I'm
couple
very
others out there.
disappointed, Michael, that you don't think we're going to increase over the last 14 years. Bitcoin has increased 68,192,810%. And I'm very,
So I don't.
very disappointed that you don't think we're going to get that over the next.
So unfortunately, I don't mean to fund here, but I don't think we're going to do that again. But
68 million%. It's just it's a mind-numbing number. And
it's outstanding.
And part of that is I don't really count the first 4 years. I know I should, but I don't really, right? Because it was a science project and we're dealing in fractions of a penny. It wasn't real, right? It wasn't there. The last 10 years, it's real. And in the last 10 years, 8 of those 10 years, including this year, Bitcoin's the best performing asset of all assets. Over the whole 10-year period, it is the best performing asset. And that's why I'm befuddled when people still have zero exposure. I'm not saying you should have 100%. I mean, that's not logical. But zero is the wrong number. It's just the wrong number.
I used to be befuddled about that, and now I'm not anymore. I had a when we used to host these like tiny little events in the very beginning of Blockworks, like first 6 or 9 months or something. I ran into this guy who went there, and we were talking about not just the old analogy that people use all the time, which is comparing crypto to the internet. Yeah. We were talking about Amazon. Well, when Amazon had all these drawdowns, it was really volatile, multiple 90% drawdowns, et cetera. And look at Amazon. And this guy said, well, it's still too early to tell about Amazon. This guy's still, he's still doubting Amazon, however long we are in. And that was a little bit, it took a little while for that to sink in with me. But what sunk in is that some people are just never going to wrap their minds around this stuff. And to just like circle back to where we started this interview, talking about Rockefeller, one of the other, things that resonated with me in the early days of the oil trade, Mark, it was like 20 years in, people were still concerned. It was a very speculative industry. Renowned men of business didn't invest in it because they're worried about their reputation, and it was rife for speculation. It's like this stuff is just, not everyone's a tech investor, right? There are guys that have made hundreds of millions or billions of dollars only investing in bonds or things like steel that they could touch with their hands. Some of this stuff is just never going to resonate with some people. And I've actually just like, you know what? I've just made my peace with that. And I know over a long period of time, it resonates with everyone who's like my age or below, and that's just going to take some time for that.
It is 100% true. The digital divide is real. Look, 29% of millennials own BTC, only 4% of boomers, and that ratio is not going to change dramatically. I keep talking about this, right? My little granddaughter, 6 months old, she's a Zoomer, right? A Gen A, and she'll never have a physical wallet. She'll never use paper money. Not ever. Yeah. That's amazing, right? That's amazing. That is an amazing fact. And people are like, no, that's not true. I'm like, yeah, it is. She will never, ever touch paper money. Paper money is going to be gone probably within the next 24 months. And the dystopian, and we'll talk about this on another show, but the nightmare of CBDCs is coming.
I think it's coming too. Yeah, I think it's coming too. And I really hope it doesn't, but I think it's...
Oh, no, it's coming. No. I'm telling you. Plan B actually tweeted about this. He said, 4533, illegal to own gold. He said 2023, illegal to own money. And I actually think it's 2024, but it doesn't matter. But it ain't 2050. Within the next 24 months, it will be illegal. Just let that word hang in the air. It will be illegal to have a $20 bill. That's a crazy thought.
Yeah.
And the reason it's crazy is when I have that $20 bill, and I don't use $20 bills very often, but I have privacy. I can do with that $20 bill whatever I want with no surveillance and no censorship. I don't have secrecy, right? I'm not doing anything illicit with it per se, but I have privacy. Privacy is good. Secrecy may be bad, but privacy is good. But if I have only CBDC, I have no privacy.
Yeah.
Now, I personally have given up most of my privacy voluntarily because I use my Visa card and I don't carry money around. And I'm not doing anything bad that I care that they see. But they have access to all of my transactions in theory. Now, I guess MasterCard and Visa would say, oh, we don't share that. Bullshit. You share. If asked, you would share. Same thing with your bank records, right? They say, oh, you can't, government can't get them. I don't know. If I read the Patriot, and look, this Restrict Act, if you are not terrified by the Restrict Act, you are not paying attention. And again, topic for another day, but the Restrict Act, look, the Patriot Act, at least they had the decency to disguise the malevolence by calling it Patriot. Right?
Mark, that's like the lowest bar I've ever heard.
This is a personal affront to the Bill of Rights.
Yeah, I know.
Bill of Rights says we have rights. This says, no, we can restrict your rights. If you have an app that we don't approve of, you go to jail. No due process. What?
Yeah.
My ownership of an asset can put me in jail with no due process? Really?
I know.
Now, I don't believe it's going to pass, but the fact that someone actually wrote that, Michael, is fucking crazy.
I'm with you.
That's literally crazy.
I think it actually is a very challenging time to be, part of look, they're having to deal with something like crypto. They're going to have to deal with AI at the same time. I haven't really brought it up that much on this podcast because you and I aren't like AI guys in this, unless maybe you're an investor in something like that. But
I'm not an AI guy.
I've got layman's sort of opinions on it, but man, these are significant technological shifts. It's going to change the way that they need to adopt an entirely new mind frame and way to regulate this stuff. That's why I've really been on this crusade of like, I just do not want these geriatrics in office deciding this stuff. I'm sorry. It's, at past a certain point, I love my grandparents, but I don't think that they should be the ones.
I don't want to make them the rules.
Yeah, I just don't want to make them the rules. I'm with you on it.
Nope.
Mark, all the time we have for today, but as always, my friend, hey, great to see you again. This is I've missed this.
Good to be back.
Nice.
Good to be back. Good to know that I'm not shadow banned on the margin like I'm shadow banned on Twitter. It is crazy. I got out of Twitter jail for about 2 weeks and I went right back in. And I don't know what I did. Well, I do. I know what I did. I liked things that other people say I shouldn't like, but it's amazing. I mean, my Twitter followership is just dead flat. I mean, it's the algorithm.
Like Elon doesn't really believe in free speech, and that was just a narrative to, yeah. All right, anyway, Mark, let's end it. Best hour of my week. Cheers, buddy.
Talk to you too.